Verizon stock just finished off one of its worst performing years in decades. Is the dividend safe over at this company? And after the massive 24% decline over the last year for Verizon, does this make this stock a good buy the dip opportunity, particularly for dividend investors? Talk about that and more on today's show. What is going on, investors? Hopefully, guys are doing well out there. Time to talk about Verizon Communications, ticker symbol VZ. Like we talked about at the top, stock over the last year down 24%. Now, we are seeing some sectors of the market kind of bounce back over the last 6 months. That is not the case with the Verizon. It's still down over 10% over the last 6 months, as you have the chip sector, you have the banking sector, several other sectors are starting to see a little bit of a bounce back over the last 6 months. Now, from a technical perspective, this one fell off a cliff, and it fell off a cliff in a way that we really haven't seen in well over a decade for Verizon. I've got a weekly chart over here, and we broke through numerous levels of support. So we'll talk about this from a technical perspective towards the end of the show. Let's kick things off with those Q4 revenues that came in before the bell for Verizon. Revenue coming in at $35.3 billion. That was 3.5% growth year over year. It beat expectations by about $160 million. Now, 2021 and a little bit of 2022 was actually a pretty capital-intensive environment for all the communication segments, particularly AT&T and Verizon, as they had to invest quite a bit in their spectrum build-out. Well, it looks like capital spending in the range of $18.25 and $19.25 billion for the upcoming 2023. That's a pretty dramatic decrease from what we saw them spend just over the last couple of years. Now, in terms of revenue over at this company, this is not going to be your high-flying growth stock, okay? You are just seeing very low single-digit revenue growth, and unfortunately for this company, for the next really over a year or so, you're actually going to see earnings kind of start to contract over at this company as well on the EPS side. When we come over to the numbers, you're going to see probably some of the reasons why. You had your total operating revenues, again, $35.3 billion. That was 3.5% growth year over year. You see it on their own financials. You see for the full year, this is the fourth quarter, so you get kind of a year over year, just 2.4% growth on that revenue side. Now, what's tricky about this company is they're obviously got people kind of locked into a contract, or they're kind of locked into a certain type of pricing based on the competition out there from T-Mobile, AT&T, and all the kind of the discount wireless players. So a company like this, in an inflationary environment where year over year you had inflation go up 6, 7, 8, 9%, they weren't able to pass that through on the revenue side, on the sales side. Otherwise, they would just lost even more customers than they already did. Unfortunately, what hits Verizon is the expense side, okay? The employee wages, all the operating costs, transportation costs, all those types of things. Those continue to rise in this environment where they're not able to pass those price increases down onto customers. So you see your total operating expenses for the last quarter went up nearly 6%. Again, that's coupled with 3.5% increases in revenues. For the full year, similar story, 2.4% rise on revenues, but unfortunately it's balanced off by over a 5% increase on those operating expenses. Now, you've got your operating income. What do you think when your operating revenues tick up 3.5% and your operating expenses accelerate even greater than that? That's right. Your operating income is actually going to go down by about 5% year over year, from $7.6 billion down to, we'll call that generously, $7.3 billion. For the full year, paints a similar story, down 6% from 32 down to 30.5. So we saw modest increases in revenues, but the somewhat more modest increase in operating expenses kind of wiped out any operating profit growth year over year. Now, at the top, we talked about the dividend, and on a quarterly basis, you're earning $1.56 per diluted share. For the full year, you're earning $5.06. The company is currently paying $2.61. And keep in mind, this dividend and this EPS, it factors in them paying back their debt, which we'll talk about when we get to the balance sheet and the cash flows as well. It also factors in income taxes. It factors in basically everything over the company. So the company's dividend, from a safety perspective and even a marginal kind of growth over the next several years, is actually very well capitalized and very much intact. So when you see this yield of 6.6%, I know we're in a quote unquote kind of higher interest rate environment. So 6.6 a couple of years ago would have been astronomical. Now, maybe a little bit more normalized. So the company has plenty of cash to cover that dividend. So if you're holding this and reinvesting in those dividends, I don't see anything to worry about, at least in the shorter term. When we come over here and look at this balance sheet, relatively the same year over year. Your total kind of cash, which includes cash and cash receivables, basically flat year over year. We're kind of looking at a yearly year over year view on the balance sheet here. Company obviously ties up a lot of their assets in property, plant, and equipment. And we saw that go up modestly year over year by about $18 billion. But overall, when we get to cash flows, you'll see that it was actually an investment year last year that obviously was kind of a one-time capitalization cost, and this company will monetize that over the next, I would guess, next decade or so. Long-term debt actually ticked down $2.7 billion, but most of that just rolled simply over to the debt maturing within 1 year. That is up about $2.5 billion. So you got about, we'll call that about $10 billion maturing over the next 12 months. When you flow down to cash flows, this is really how you want to analyze this company. From an operating perspective, I think you get a nice window into the dividend and the dividend coverage. You get a nice window into how revenue growth is kind of being offset by the operating expense increases. But with a company like this, you do have a major depreciation and amortization expense that they expense up front when they build out these wireless spectrum, when they're building property, plant, and equipment. They expense that up front and then they depreciate that over time as a non-cash charge that is recognized when you look at the financials. You see here, your depreciation and amortization expense comes in at $4.2 billion. For the whole year, it's about 17.1. So on cash flows, we actually get to add that back in. That's significant, okay? When your net income is $21 billion for a full year, you get to add back in over $17 billion in non-cash depreciation. What I noticed just anecdotally here as well, here's your provision for expected credit losses. That is up tremendously year over year. So that could be telling us something just anecdotally about the customer out there not paying their Verizon bill as much or as frequently as they did a year ago. Now, come down here to net cash provided by the operating activities, still down year over year from about $39 billion down to about $37 billion. It was about a $2.4 billion decline on those operating cash flows. Now, here's the big difference year over year. Here's your acquisitions of wireless licenses over at Verizon. Last year, AT&T, Verizon, T-Mobile, all these companies were having to spend big on these 5G wireless licenses that the government was auctioning off to the tune of $47 billion. That is $47 billion just in 1 year. Now, this year, notice they didn't really have to do much at all, just nearly $3.7 billion of that. Here's your capital expenditures over this company coming in at $23 billion. And when we talked about at the top, the company basically guided for $18 to $19 billion and some change on that side. And so you are going to see year over year, things are going to start to continue to improve for Verizon. They're not going to have to keep spending $40 billion on wireless license. That's something that you typically do all at once. And then again, the 5G rollout has already occurred, and now you're going to monetize that over the next, I would assume, 5 to 10 years or so. Same thing, that took a lot of capital expenditures to roll that out and reinvest in that. So you're going to see a decline here as well. So notice your net cash used in investing activities went from $67 billion last year down to $28. And my guess is you're probably going to see a slight decline there as well heading into next year. So the company's going to have plenty of money come down here to use for their financing activities. And here's where they borrow some debt, they pay back some debt, and here's where they pay your dividends as well. $10.8 billion over the last year paid in dividends. And here's where we'll give a round of applause to the CEO over at Verizon, the CFO, the Chief Financial Officer over at Verizon, did a fantastic job over the last year. Here's your decrease in cash to cash equivalents, just a small, we're not even talking about a rounding error, just $50 million on a company with $37 billion of positive operating cash flow, another nearly $29 billion in investing activities, and another nearly $8.6 billion in financing activities. They basically balanced it off perfectly in terms of uses of cash. That's what you love to see in an inflationary environment where cash is so valuable to balance it off this beautifully and this perfectly from a mathematical standpoint is a thing of beauty. Now, the last thing I wanted to show you is the company in their press release, they're going to say, hey, we set a record doing this. We had all these additions, and they're only going to tell you the people that bought a new phone or bought a new postpaid plan or bought a new internet plan. With these companies, you really just want to come down to churn because that factors in the people that cancel. And you see year over year, basically across the board, a little bit not so in retail postpaid, but almost across the board, we're seeing an increase in churn. And then when you come over here to retail postpaid accounts, those are actually down. I mean, it's almost flat, but those are down year over year. So Verizon is going to stay likely relatively steady in terms of its revenue, in terms of the number of count it has. It's just going to be this steady business that generates a large amount of cash flow, that has years and periods of time where they have to invest all this money into their network, but then they're going to have periods of times over the next several years where they're not going to have to invest in much of that, and so they're going to be able to pay down some debt, continue to pay these dividends over at Verizon. I think that's why we're seeing the stock reverse a little bit. This thing was down at about $35 per share. It's bounced back more recently. I'm on a weekly chart, so all of these bars represent 1 week of time. It's bounced back up to $40. Broadly, what I just wanted to show you kind of relates to the S&P 500 as well. The S&P 500 has been in this kind of longer term downtrend, and it finally broke out this week, and we'll see if that follows through over the next quarter or two. But one thing to keep in mind is don't chase the breakout, because oftentimes you have these large kind of euphoric breakouts like we saw with Verizon, only to be followed by some kind of back test back to the bottom of the top of the channel. Similar type thing could happen here with Verizon as well. We've had this massive downtrend with this stock. Wouldn't surprise me if we have some kind of shorter term breakout. There should be some resistance for the stock up here at about $46 per share. That was, I mean, we're talking about years long of support for the stock. Keep in mind, as the stock price ticks up, it actually negatively impacts the yield that you're getting, especially when you're buying into this stock for the very first time. And so as the price of this stock ticks up, it actually makes it a little less attractive from a dividend perspective. But all things being considered, this stock is still locked in a very, very steep downtrend. And until you really see signs of it kind of breaking out over that, maybe retesting this 46 area, I would actually expect this to continue to kind of work its way down, as I'm not really sure if investors will be rotating into stocks like these if we get a bear market, and if we get maybe a bear market followed by a bull market recovery. Are they really going to pile into stocks like Verizon? This still remains a stock for somebody that wants to collect a dividend over a period of time, maybe earn some income on that. You are assured that the cash flows, the capital expenditures, all those types of things are going to normalize, I would assume, over the next couple of years. And so there's going to be plenty of cash to pay those dividends over at this company. Hopefully, you guys enjoyed today's video. Obviously, be back a lot more this week with lots of earnings. We'll see you again soon. Good luck with your investments.